Dear members, greetings. Welcome to the Lending 101, and your presenter is me, Mr. Ferdinand John. Today we're going to continue with our previous lesson, and that was about credit risk protection or securities. Please stay tuned and get ready for the lecture. In our last session, we covered a number of items that are acceptable to serve as a security or collateral for the loan. And these are items that are acceptable by almost all conventional banks or commercial banks that are operating here in Tanzania. One of these items we discuss are such as bank deposits, life policies, stocks and shares, treasury bills and bonds, debtors and inventories, landed property. Here it means plots and buildings, as well as movable assets such as equipment, vehicles, etc. More discussion on this, or if there is anything you want to understand, or for some reason you didn't comprehend regarding these items that are acceptable to serve as securities for the loan, please refer to our previous lecture, which is already uploaded in our website. Also, we discussed a number of charges that are done by commercial banks operating in Tanzania. Such charges are such as lien, pledge, guarantee, debenture, mortgage, and life policies. However, we also discussed that these charges or the kind of security that is acceptable by any given bank will depend on the credit policy or lending guidelines of that particular bank, objective of that bank, and also the degree of risk involved in that lending proposition. That will depend on the type of customer. And in our last discussion, we focused on lien, pledge, chattel, and now today we're going to continue with mortgage, guarantees, debenture, and life policies. Please stay tuned and get ready for the session. So ladies and gentlemen, now let's continue with the mortgage. Now before we could start our discussion any further, first we need to comprehend the exact meaning of the mortgage. Mortgage simply means the transfer of rights over the property, normally the lended property, by the borrower or the third party called a mortgager to the lender, known as the mortgagee, as a security for payment of the debt. What exactly does this really mean? So a mortgage simply means that the borrower transfer his rights over a certain landed property, can be a plot or a house, and these rights are transferred to the lender. Now the lender here can be a commercial bank, housing financing firm, mortgage firm, etc., etc. Therefore, that is to say, a borrower comes over to the bank asking for a certain credit facility, call it a mortgage, there by pledging or by transferring the title over his landed property to the mortgager, to the mortgagee, meaning that if it happened that the borrower failed to repay or to meet his contractual obligations, then the mortgagee, that will be now the bank, will have the right to realize the lended fund or the borrowed fund from the sale of the mortgaged property. That is what we call the mortgage. So here it means the transfer of interest can be not only for the landed property but also for stocks, shares, etc., etc. Now also we have what we call the chattel mortgage. Now the chattel mortgage, that is created over movable properties. That is, when we talk of landed property, for example, a plot or a building, those are immovable property. You cannot move them. So you simply transfer your rights. That is, you give the document of title to the lender. Now with the movable properties or chattel mortgage, here we're talking of movable items such as heavy machines, equipment, etc. So also a borrower can go over to the bank and create what we call the chattel mortgage. So that is to say, now mortgage is not restricted to only landed property. in the sense of building and plot, but also movable properties such as vehicles, heavy machines, plants, etc. Something that is movable. However, during the entire time of the mortgage contract, the possession and ownership of the property will remain with the borrower, but the lender will have the rights only if it happens that the borrower has a default. But if the borrower has duly fulfilled its contractual obligation, then the lender is supposed to discharge the mortgage. Now, there are two types of mortgage. Number one, a legal mortgage, and number two, an equitable mortgage. These are two distinctive types of mortgages, and we're going to discuss them very soon. Now, let's start with the legal mortgage. With the legal mortgage, here there is a transfer of legal interest of the lended property or any other property that has been pledged to serve as the security for that particular loan. That is to say, now, the lender's interest must be registered with the lending registry in case, and this is just in case, the mortgager is a company. So, just to insist here, if you are a bank officer and you have a borrower who happens to be a given company, then please ensure that the property that has been mortgaged to your bank is registered to the land registry if you are dealing with a company. Again, the mortgage has to be registered with the registers of the company as well. Now, a legal mortgage of property will give the mortgagee, that is the lender, the banker. So the banker will have rights against the property itself with no need to consult the court or the mortgager, who will remain the legal owner. Remember, I've mentioned to you that during the entire tenure of the mortgage contract, even though the rights were transferred to the banker, but still the rightful owner of the property is the borrower. Now, the good thing or the good news with the legal mortgage is that in case of default, the lender does not really want to consult the court nor the borrower when the lender wants to sell the lended property or the mortgage property in order to realize the borrowed funds. This is the good news with the legal mortgage. So, the right of sale is enjoyed by any bank with a legal mortgage created by deed as the right against the property. So, to have this right, we have to create a mortgage deed, and once the mortgage deed is created, it has to be executed and registered properly. Then let's discuss in a nutshell about the equitable mortgage. Now, the equitable mortgage is quite the opposite or quite different from the legal mortgage. With the equitable mortgage here, we see that there is a transfer of interest. Now, the transfer of interest is done only by the borrower when he deposits the title deeds or the document of title of a certain property to the lender. Now, this is done without registering the lender's interest with the land registry. So you can see with the legal mortgage, the title, the deposit, or the mortgage itself has to be registered. But with the equitable mortgage, this is not done. So this means that the equitable mortgage is very, very weak compared to legal mortgage. Why? Because if it happened that the borrower has defaulted, then the lender cannot simply go out there and sell the mortgaged property without consulting the borrower. So that is to say, now, if a banker wants to execute an equitable mortgage, they have to ensure that this is done if there is no any other alternative in case of the borrower, and also the integrity of the borrower is unquestionable. Short of that, the equitable mortgage can bring a number of problems to the lender. So we have to understand that an equitable mortgage will give the banker the right of sale, but also this right of sale can happen only and if only the borrower has consent. So if the borrower does not consent, if the borrower decided to go to the court, he can prevent the lender, that is the bank. So the borrower can prevent the lender from realizing his funds from the sale of that particular asset. Now, we see that here we need to create what we call a memorandum of deposit of deeds, and this memorandum of deposit of deed must be signed by the mortgagor in order to assist the lender to realize his funds in case of default from the selling of that particular security. Short of that, it will be a little bit difficult for the borrower to for the lender to realize his funds in case of default. Now, ladies and gentlemen, now let's focus our discussion on the creation of a mortgage. Now, once a borrower has approached your bank asking for a mortgage, there are a set of documents that's supposed to submit to the bank. The first document is known as the certificate of occupancy. Now, certificate of occupancy, this is the document that evidences that indeed the person whose names appear on the particular certificate is the rightful owner of the mortgage property. That can be a plot or a building. But in some other circumstances, it happened that the owner of that particular property does not have the certificate of occupancy, rather a letter of offer. So again, even a letter of offer can be acceptable. However, certificate of occupancy is very, very good document that has to be produced. It is better than the letter of offer. Besides the certificate of occupancy or letter of offer, also there is leseni ya makazi. Leseni ya makazi, this was the initiative done by the Ministry of Land and Houses in Tanzania. So the minister, by knowing that it takes some time for Tanzanians to obtain this so-called certificate of occupancy, he came over with this initiative of issuing leseni za makazi. Therefore, the leseni ya makazi may be considered for small loans, but we have to take precautions. This is because leseni ya makazi has a validity of 5 years. Now, besides the first document, then second is land rent clearance certificate. Now, the land rent clearance certificate, this is a document that is issued by the revenue authority of a given country. So in the case of Tanzania, that will be Tanzania Revenue Authority. Remember, once the owner of a given plot or building has a certificate of occupancy, they are supposed to pay land rent every single year. Failure to do so, they will have an accumulation of land rent debt, and the Tanzania Revenue Authority or any other government authority might come over to realize the accumulated debts from the selling of the landed property. Therefore, a banker needs to be sure that the mortgaged property is free from any debt or any accumulated debt from the government authority. And as the evidence of no any single debt of the mortgaged property, then the banker will require the borrower to produce land rent clearance certificate that is issued by the Tanzania Revenue Authority in the case of Tanzania. Next thing is the valuation report. Now, the valuation report, this document is issued by a registered valuer. We all know that not all bankers are very competent in doing valuation of buildings or plots. There are some, this is different profession from the banking profession, and there are some professionals who are supposed to do so, and these are called valuers. And now we need a valuer to be registered by the government authority in order to avoid cheating. Therefore, the valuer will visit the landed property or the property that is intended to be mortgaged, and over there will come out with the exact value of that particular property. So this will assist the bank to know if the value of that particular property really fits the credit facility that is intended to be offered. Remember, one of the attributes of security we mentioned is value, and regulations issued by the Bank of Tanzania needs the security to cover the credit facility by 125%. Therefore, it is the duty of the banker to ask the borrower to go to a registered valuer and bring the valuation report. Next is the memorandum in writing to the land registry. Now, let me take you back to the certificate of occupancy. According to the laws in Tanzania, once you are given the certificate of occupancy, it does not really mean that indeed that particular property, land, belongs to you. Rather, you have just leased that particular land. So the government has just allowed you to use that particular plot for the uses that have been mentioned on the certificate of occupancy for a number of years documented on that particular certificate of occupancy, let's say 30 years. So for example, if you have a certificate of occupancy of a plot intended to be used for residential for the period of 30 years, it means the government has leased you that particular land or plot for the period of 30 years. That is to say, after the expiration of 30 years, the government has the right to take that particular property, land or plot from you, or it might even change the usage of that particular plot. But also, the government does not have to wait for the 30 years to lapse, or the period mentioned on the certificate of occupancy to lapse. Rather, the government might even change that before the lapsing of that particular period. However, if you have certificate of occupancy, it means the government will compensate you. Therefore, a banker will need the land registry memorandum, and that has to be in writing. So the land registry will declare that during the entire tenure of the contract, that is the mortgage contract, no any changes will be done on that particular plot or land. That is the essence or rationale of this document. Next is the consent of the spouse if it is matrimonial property. It has occurred in several occasions that people who are in marriage, one of them will go over to the bank, take a loan, pledge matrimonial property as a security, and then they default. Once they default, the bank go over there to recover their loan, later to find out that one of the spouses knows nothing about the loan. Therefore, this time around, the banker will need the consent of both spouses. Therefore, if the borrower has mentioned that he is married, then we're going to need the partner to come over and sign this document before the banker. It is very, very important. Next is the board resolution letter. Now, this letter or the resolution by the board is only for the companies. Remember, a company has what we call MEMAT, that is Memorandum of Association, and Articles of Association. Now, the Article of Association has rules and regulations that govern the particular company, while the Memorandum of Association shows how the company was established, the line of business, etc., etc. Now, the board is supposed to consent that indeed it has allowed the management of that particular company to go and mortgage a certain landed property for a loan. By doing so, the board will issue its resolution letter, and this is what we call the resolution letter issued by the board of directors of a given company. Now, earlier I mentioned that the first document that I mentioned was the certificate of occupancy and letter of offer. Now, with certificate of occupancy, no problem. The name written over there, it means that indeed is the rightful owner of the property. But with offer, it's a little bit different. We need to treat the letter of offer with caution. Therefore, if a banker is to accept an offer, then it has to obtain a commitment from the borrower that indeed once the certificate of occupancy is issued, then the borrower will right away go and submit that particular certificate of occupancy to the banker. That is very, very important. Now, obtaining these documents is not enough. The lender also needs to make his own assessment. This assessment will assist to reach into a sound decision. Now, the assessment will be based on the following: with the value of the property, age of the property, that is for how long the property has been used, usage of the property, and location of the property. Remember, attributes of security: good title, marketability, and value. Therefore, it's very, very important for the lender to ascertain these aspects as regarding to the property that is about to be mortgaged: value, age, usage, location, and last, the unexpired period of the title. Remember, I mentioned that the certificate of occupancy has a duration, can be 20 years, 30 years, 15, etc. Therefore, it's very, very important to ascertain the unexpired period of the title. For example, if the certificate of occupancy was issued back in 1984, so to date we are talking, to date it is almost 36 years. Now, if the certificate of occupancy was issued back in 1984 with a duration of 30 years, it means now it has elapsed. But what if it was issued in 1994? So if it was issued in 1994, it means right now it has 26 years. Now let's say that the borrower wants a mortgage of 10 years and the certificate of occupancy has a duration of 30 years. It means there are only 4 years left before it could expire. That is to say, now that title is not good because the certificate of occupancy will expire in the period of 4 years. Therefore, it is very, very important to ensure that you really understand the time which has remained on that particular certificate of occupancy. Now, let's continue with the creation of the legal mortgage. Now, that is, once you have obtained these documents, the next step is for you to do verification. That is, a banker is supposed to make a search at the land registry and at the registrar of companies in case of a company, just to find out that indeed those documents are legit and there is no any previous charges created over the same property. This is very, very important. It has happened several times that two banks come and collide. That is, two banks come out to find out that a single property has been mortgaged with both banks, and so it brings a problem when it comes to the realization of the borrowed funds in case of default. Now, just to be sure that the lended property or the mortgaged property was never charged somewhere else, it is very important for the banker to make a search at the land registry and at the registrar of the companies to be satisfied that indeed the documents are legit and also there's no any other charge somewhere else. So if the documents are found to be clean, then the banker is supposed to draw a mortgage deed, and in the mortgage deed the banker will stipulate all terms and conditions of the mortgage. So there are some clauses that will be included in that particular mortgage deed. For example, continuing security, repayment on demand, and conclusive evidence. So now let's discuss in detail the main clauses in the mortgage deed. As I mentioned earlier, number one is continuing security. Now, by saying continuing security, it means that the mortgaged property will serve as the security for that particular mortgage for the entire tenure of the mortgage. There's no way it can be discharged before the lapsing of the mortgage contract. The payment on demand, this is just like it's a covenant to be used in case of moral hazard. That is, a banker is allowed to recall the entire mortgage, that is, the borrowed funds and its subsequent interest outright. And by doing so, the borrower will suppose to make full payment of the borrowed funds and its interest on demand. Short of that, there will be some legal consequences. Conclusive evidence, this means that just in case it happened that the borrower has defaulted and the banker wants to realize its fund from the selling of the mortgaged property, and for some reasons the borrower has taken litigation, that is, now the matter has been taken to the court, then conclusive evidence requires the banker to ensure that the mortgage is created in such a way that at the court there will be no more evidence required by the court. Everything is presentable, everything is in the manner that the court will simply make a decision. That is what we call conclusive evidence. And then there is also another aspect we call succession. Unfortunately, succession is not shown on my slides, so please write it down. Succession, S-U-C-C-E-S-S-I-O-N. Succession. Now, what does it mean, succession? Succession, there are some circumstances, that is, two businesses can merge, or one business may acquire another business. So in finance, there's what we call merger and acquisition. Now, let's assume that a borrower has visited Bank A and took a mortgage. Then Bank D has come over and absorbed Bank A. So once Bank D has absorbed Bank A, it does not mean that the borrower, the mortgager, who has taken some funds from Bank A is freed from his obligation. No. Under the succession, it means that that debt will continue and it has to be paid now to the Bank D that has acquired the Bank A. That is succession. Now, gentlemen, ladies, let's focus now on the creation of legal mortgage. Once you have obtained all those documents, and the next thing now is the execution. The mortgager will be called upon to execute the mortgage deed before the commissioner of oath. And if in case that the mortgager is the company, then the execution has to be done under the seal of that particular company. Again, do not forget to obtain the consent of the land registry, and thereafter the bank attorneys will execute the mortgage deed. For companies, the charges has to be registered with the registrar of the companies, who will issue a certificate of registration of charge. Remember, before we execute the mortgage, we request the borrower to provide us with some documents. And those documents, the banker had the responsibility to go over to make a search to verify that indeed those documents are legitimate and that there is no any other charges created. Therefore, if everything is intact, now to execute this legal mortgage, the banker is supposed now to register the mortgage at the registrar of the companies. And also, the registrar of the company will issue a certificate of registration of charge, meaning that the mortgaged property can no longer be used by the same borrower to ask for a loan somewhere else until this mortgage is discharged. Now, in order to have the interest of the lender noted in the certificate of occupancy, it's very, very important for the document to be forwarded to the registrar of titles, and the property stamp duty must be paid. In the case of equitable mortgage, the creation is done by depositing the title. That is, the borrower will come over to the lender, the bank, and deposit the title of those documents. After doing so, the lender will create what we call memorandum of deposit deed, signed, and then a power of attorney will be obtained in case of the memorandum of deposit of deed does not incorporate authority to create a legal mortgage. So, now that we have created mortgage, whether it's legal or equitable, what are the rights of the mortgagee and what are the rights of the mortgager? Mortgagee here, it means the bank, the lender. So, under these mortgages, what are the rights of the mortgagee? Under legal mortgage, the first right is known as the right to sell the property. That is to say, the lender is allowed to sell the property without having to go through the court. That is the good news or the best thing about legal mortgage. In case of default, the lender is allowed straightforward to realize his funds, the borrowed funds, from the selling of the mortgaged property. The borrower, however, must be informed, must be given sufficient notice that his debt is overdue and that the seller is intending to sell that particular property. So yes, even though the legal mortgage provides the borrower with the right to sell the property without having to go through the court procedure, but still he is obliged by the law to ensure that he does inform the borrower about the intention to sell his property. The next right, there are some rules governing the sale of that property. That is, number one, the selling of the mortgaged property must be by public auction. This again is very, very important. You cannot do this in secret. It has to be in the public, and this can explain as to why nowadays we see banks will announce, if they want to sell some properties, will announce in almost every media available countrywide, and afterwards they will use loud hailers in vehicles, and again they will conduct an open auction for the public. So it has to be so. This is according to the law. Then the lender is strictly prohibited from selling the property to himself directly or indirectly. Indirectly, that is through friends or any other third party. It is strictly prohibited. The lender needs to sell this property on the public auction to the public and not to himself. Again, before the selling, the lender needs to ensure that they get an independent valuer. That is, the value, remember, mortgaged property, lended property particularly, they tend to appreciate in their value over time. So, even though during the creation of the mortgage, there was another value was assigned to ascertain the exact value of that particular property, again, right now, we're going to need another independent valuer to come over and ascertain the current value of that particular property. This will assist to avoid cheating. Again, once the selling has been done, the lender, the bank, is supposed to inform the mortgager, that is the borrower, that this is the amount that have been realized from the selling of the property. And so, if there are some remaining, that is to say, once the lender has deducted the borrowed funds and administration costs, the rest of the money needs to be credited to the borrower. Another right is the right of consolidation. The right of consolidation happens when a borrower creates several mortgages secured by the same debt at the same bank. That is what we call, that is how the consolidation happens. So, the lender is allowed now to consolidate, to combine those separate mortgages into one and demand repayment from the borrower. Again, the lender can also refuse redemption of one mortgage and insist all to be repaid. So, this right, this clause, provides the right to the borrower, to the lender, to demand repayment of all debts, all the consolidated debts, because it is the lender who knows how much he has hustled to recover the debt from this particular borrower. Then there is the right to tack. According to section 60 of the Land Registration Ordinance, Cap 334, Mortgages rank according to the order they are registered and not according to the order they are created. Again, this is very, very important. Let me narrate this by using example. Let's assume that we have two banks. We have Bank A and there is Bank B. Now, again, we have a certain borrower, call him Company C. So, Company C, on 26th of March 2020, Company C approaches Bank A for a mortgage. Then, all procedures were conducted as required by the guidelines of that particular bank, and it reached out that the Bank A is fully satisfied and decided to issue the mortgage. Now, the mortgage property, let's say, is a plot. Now, afterwards, Company C approaches Bank B, and again, by using exactly the same property which was mortgaged at Bank A, Company C requests another mortgage at Bank B. That was, let's assume that this is done on 29th of March 2020. That is 3 days after the execution of a mortgage at Bank A. Now, at Bank B follows all the procedures, and one step further, Bank B go over to the lending registrar to register the mortgage, to register the charge. So remember, Bank A has executed the mortgage, but the mortgage was never registered. Bank B executed the mortgage and registered, so the mortgage is fully registered. And the registration of this mortgage means that it will prevent the same or the exact security to be used as collateral for another mortgage somewhere else or at another bank. Now, suppose further that Company C defaulted from his obligation to both banks. It comes a time where now both banks want to realize their funds from the mortgage property. Now, remember, the mortgage property is exactly the same to both banks. Since Bank B registered the mortgage, even though all the procedures were done a number of days after Bank A has executed its mortgage, then here the right to tack, it will provide the right to Bank B over Bank A, simply because Bank B was the first to register the mortgage, even though everything was done lately. But since it was first to register the mortgage, then it will outrank Bank A. This is the meaning of the right to tack. Then there's what we call the right to sue. That is, under the concept of debt and repayment, the banker is allowed to sue the mortgager, that is, the borrower, in case they do not meet their obligation. But since court procedures are costly and will take some time, the creation of legal mortgage allows the banker to sell the asset without having to go through the court procedures. So mortgages are taken because suits are time-consuming and costly, and with a legal mortgage, the lender can sell the property without having to go into the court. Now let's discuss another right, that is the right to take possession. Now, the right to take possession allows the mortgagee, that is the banker, to enter into the mortgaged property and occupy it as long as the loan is not repaid. So let's assume this is the building, and the building was mortgaged. Therefore, a banker is allowed to take some rooms in that particular building. However, since the lender has occupied that particular building, then he suppose or he will assume all the responsibilities of keeping that particular building in shapes. but any collections or proceeds from the property will be used to repay the loan, and the lender has to account to the owner. That is to say, even though the banker has taken the building, has possessed the building, let's say now it is the banker that is collecting some rent from that particular building, the proceeds need to be accounted to the rightful owner, that is the borrower. Then the right of redemption. Now the right of redemption, this is the right of the mortgager. That is, the mortgager has a right to pay back the borrowed money and get back the mortgaged property anytime. So that is to say, if the mortgage was for 20 years and for some reasons within 10 years, let's say year 9 or year 10, the borrower has received some funds, he can go back to the banker, pay back the mortgage, and request his property to be reverted back to him. So remember, the banker cannot refuse. That is the reason we say once a mortgage, always a mortgage. Another right is the right to get back the title deed. That is to say, once the banker is fully satisfied that the debt is fully repaid, the banker is supposed to return back the certificate of occupancy, COO, and any other documents without any hindrances. These documents has to be returned to the borrower, that is the mortgager. Another right is the right to get an account on the sale of the property. Remember, legal mortgage allows the lender, the banker, to sell the property without the consent of the mortgager. But again, the legal mortgage provides the right to the mortgager. That is, the banker needs to account to the mortgager the exact amount realized from selling of the mortgaged property. Despite the fact that it is the auctioneer who conducts the auction, but he does that on behalf of the lenders. Therefore, the banker cannot say that it is not responsible for selling of the security simply because the auction was done by a third party, that is the auctioneer. For instance, in Tanzania we have seen a number of auction companies like Yono, Majembe, etc. Therefore, those companies actually they operate or they work on behalf of the principal, and the principal here is the bank. Therefore, again, the banker is the one who is supposed to be accounted to the mortgager and not otherwise. Now let's discuss discharge of mortgage. Discharge of mortgage occur only or right after the entire mortgage has been repaid. Therefore, if the debt is fully repaid, the next step is for the banker to discharge that particular mortgage. I should mention, however, the death of mortgager does not discharge the property. As long as the debt is still there and the borrower has passed away, then the mortgage will never be discharged. The mortgage will continue to be there unless the debt is fully repaid. Also, it is true that if it happens that the mortgagor sells the property to another person, the property is acquired with an encumbrances, and that is to say now, this property will never be freed until the debt is fully repaid. However, to prevent this situation from happening, the banker usually will want the mortgagor to deposit the document of title of that particular property to the bank. This will prevent the mortgagor from selling the property behind the back of the bank. As for the legal mortgage now, if the debt is fully repaid, remember, legal mortgage was registered before the Commissioner of Oath and to the company registrars in the land registry. Therefore, documents will have to be forwarded to relevant authorities. Those are the three authorities which I have mentioned, in order for them to be discharged. In case of repeatable mortgage, the first thing is for the bank to cancel the memorandum of deposit of deeds. Next thing is for the banker to hand over documents to the owner. Therefore, ladies and gentlemen, this marks the end of this brief presentation. Our next presentation will focus on guarantee. Please, should you have any concern, any questions, do not hesitate to write down your questions, and the facilitators will reach out to you as soon as possible. Thank you very much. I wish you good day.